This is Tom Aspray with the Viper Report. Before we get to this weekend's market wrap video, I'd like to invite you to join me this coming Friday, March 24th at 10 a.m. Eastern or 7 a.m. Pacific time for a brand new presentation that is geared towards today's market and what's happened so far in 2023. I think the things I'll discuss will help you be more successful in the year ahead. There's a link in the email, and I hope you'll take advantage of it to sign up and join us. Those who do sign up with us will also have access to a recording of the event if they aren't able to make it live. As the week started, we expected the bank and financial stocks to be under heavy pressure. They didn't disappoint, with 3 banks going under at this point and lots of panic in the financial markets. But the overall averages were mixed. This chart of the NYSE Composite, the broad market average, shows you it got hammered the last couple of weeks. It was down a couple percent for the week. And you can see that the AD lines, after breaking the downtrend here, has also now broken its uptrend with this week's action. The weekly market internals were quite negative. 943 up, 2273 down, 534 new lows, and just 62 new highs. But if you look at the other market indices, you might not know it. If you look at the Dow was just down 0.2%. The QQQs were up 5.8%. The S&P was up 1.4%. Transports down 3%. Utilities up 4%. And gold up 5.7%. So the Russell was down 2.8%. So it was sort of the weakest in this very mixed market environment. For the Spider Trust, you can see it's decisively broken its uptrend too. Had a low last week of 380 and change, so it's back into this area. I think this low was 374.77 or something. So that's the next key level we're watching. As I said, we did close higher for the week, even though its stocks were hit on Friday. Would not rule out a push back up to this former, uptrend. Remember, once support is broken, it now becomes resistance. But if you look at the AD lines, they've already broken below those December lows, so that's not a good sign. So, a rally in that would not change the overall downtrend if you look at those 2 highs. If you look at the daily chart of the SPY, you can see, perfect rally up above its 20-day early in the month, sharp drop, another rebound back up here. So, Thursday's low at 386.29 is now short-term support. If we break that, then the Stark band's down in here in that 376 area. You can see the daily AD line, already got back to the December lows here. And, it already closed below the lows we saw, on Wednesday. So not a good sign there. Much different picture for the QQQs, strong close. As I said, up 5.8%. Is now up 14% for the year. AD line turned up because the advanced decline numbers on the Qs, the NASDAQ 100, were positive. More impressive is the relative performance here. It's showing a very sharp uptrend, as tech really supported the overall market. If tech had been lower last week, though the relative performance analysis indicates that the QQQs are likely to be the new market leader once the overall market turns higher, would not be chasing it here. I tend not to buy one sector when the overall market looks weak, but it was a good idea this week. But you can see now we got up to the upper daily Stark bands here. The number of stocks above the 10-day has rallied from about 3 up to about 62. You can see this trend here. So that suggests it's likely to pull back in the week ahead. Another way to look at the disparity between the market averages is this performance chart in stock charts. You can see in red we have the QQQ. Okay, it goes back for 1 month. In blue we have the S&P, and in black we have the New York Composite. You don't see a shift that's dramatic often. You can see that the NYSE Composite has a lot of financial stocks in it, so it's been crushed. It was very strong at the end of last year and early this year. The longer term view shows that at the start of the year, everything was rallying, particularly the NYSE composite here was leading on the way on the upside up until the start of February, and that all changed. And quite a different picture over the past 2 weeks. One of the ETFs we have liked this month has been the semiconductors, which have been really bucking the trade. They're plotted here in green. You can see we got a nice little setback in here where we were doing new buying, and it's up pretty dramatically, particularly when compared to the NYSE, and to a lesser extent the S&P 500. But it's still outperforming the Qs, and technically it does not look like the rally is over yet. However, when one sector outperforms and leads the other one, if there's increased fear, like there has been in the past couple of weeks, sometimes everything gets sold. Of course, the action in the bond market has really got everyone's attention. You can see this weekly chart. We triggered a weekly doji a week ago here, and we're heading back down. We break this support around 3.334. That would suggest we're going all the way back down towards 3%. MACDs on a weekly basis tried to turn around, off that last rally, but failed. You can see we didn't cross here, and the MACD hiss has flipped back to solidly negative. The top in yields was even better signaled by the daily analysis. You can see we had this spike up here at the start of the month, but longer term divergence in the MACD lines and the MACD histogram, and then drifted in the sell level as expected. Now we can see that support around that 3.325, 3.33 area. Of course, the Fed's working on rates. Anyone's guess about what they'll do. I would think that either raise it 25% or do nothing. I think if they raise it 50, it may put further pressure on the stock market, but I've been surprised before. You can see how well the MACD analysis works on this market where we don't have things like volume to analyze. If you look at the shorter term, the 2-year yield, you can see that this is a record-breaking decline here, from above 5% to a low last week of 3.747%. So technicals look, negative here. Obviously is oversold, so you can't rule out a bounce back up here, even to 4.4%, which is a gargantuan move and seems unlikely. But these markets are definitely not as liquid as they have been in the past, so that makes the swings even larger. Of course, the yield picture has been helpful for the euro here. Looks like it's completed its pullback here. OBV is leading prices. HPI is turned up from support, so we need to see the euro futures get above this peak here, which is at let's see, 1.08245. That will be a confirmation that the dollar's going to break to stronger support. You look at the weekly chart of the euro, that supports that view, and you can see a strong close. OBV is positive. HPI is below its moving average but has turned higher, still above the zero line. It was a great week for gold futures and for GLD, which we were fortunate enough to get long near these recent lows. Strong volume last week, closed above the weekly start band, but in the metals that doesn't mean that the top is in place, and it looks like we could get a significant breakout the way the OBV and the HPI are acting. For traders, I would look to take some partial profits, above 2,000 in the futures, and we'll give specific targets in the ETF report. A few markets that get me concerned that on the intermediate turn are featured in this chart of the weekly S&P 500. Okay, looks like resistance now around that 3964 up to 4,000. Bullish sentiment is really, that doesn't worry me. It's down to 1920. So it's in bottoming area, but these other indicators, you can see the NAAIM. We got the breakout I was looking for above 80%, but since then it's broken down and broken its support. So it looks like the institutions are getting less enthusiastic about the stock market. That's not a good thing. The weekly analysis, some of the other AD lines, we talked about the SPY. You can see the NYSE stocks only has also broken its support level here. And, the NYSE all AD line, which had been acting stronger, and was a tip off to the rally at the start of the year, is now testing its support. And you wouldn't want to see it break below this intervening low that we made in December. Another measure of the breadth is in green here, the number of stocks above the 20-period exponential moving average. It's getting down to oversold territories, but shows no signs yet of a bottom. Same for the 50-day and the 200-day. They're all, at relatively low levels, but they can go lower and really show no signs of a bottom yet. Put call ratios. We saw a little bit of a surge at the start of the week, up to 1.2, but really nothing, to indicate an extreme level of pessimism that is reflected in the AAI bullish numbers. So a bit of a quandary there. If we had higher put call ratios, I'd be a little more positive on the market, but without them, it looks like we're going to still see that peak of bearishness before we can really turn high. As for the futures analysis, we had a deviation flip on Friday, not confirmed here because the confirming indicator are these two moving averages, and so it has not flipped yet. It could, if we get another push back up and then a further downside reversal. You can see the volume, did turn positive here on the rally from that low, and now is back to negative. Stochastic confirmer has turned down from overbought levels above the upper linear regression channel, and that's not a positive sign. The daily futures analysis is still negative. You can see this MS1 here has acted as a really good, the midpoint, between the S1 and the pivot has really acted as a good barrier, as it often does. And, so heading into the week ahead, that'll be, if we get above that level, then, the pivot here for the month is at 40.79. That should, also be a tough barrier to exceed. Daily stochastics is positive. One market that has me a little worried is crude oil. You can see this sharp plunge last week. It's also very oversold on a short-term basis. You can see we've been hugging the lower Stark band for the past couple of days. Suggest we could see a bounce back up here, but 72 to 76 is going to be a tough area. So I'll be watching for a rally failure of that, and I'm concerned about what implications of a sharply lower crude oil prices may have on the overall market. So stay tuned. That's all I have today. I'll be updating this analysis, of course, next Friday, and I hope you'll sign up and join me. Take care. Should be another fun week.